All right. So, hi everyone. I'm Ian Hunter. I'm going to give it a minute or two for people to file in before we start the panel. I think by this point in the pandemic, everybody's an old hat at Zoom.
Yeah, we've been using Blue Jeans, and so I think we're like the odd one out.
Okay. I haven't heard of Blue Jeans. All right. Well, I'll just go ahead and get started. My name's Ian Hunter. Thank you all for attending tonight's panel on investing in small and micro caps outside of the US. We have a great panel today, and we're fortunate to have not only great panelists, but a great host. I always feel lucky when you have a host who knows just as much about the subject as the panelists. And so we have Ben Claremon, who's been with Cove Street Capital in LA for many years. Cove Street manages over 700 million, and Ben is a co-portfolio manager of the small and mid portfolio. And Ben, if I didn't get that right, let me know. But I'm going to hand it over to Ben, and I think we're in for a fun conversation tonight.
Ian, thanks a lot. Yeah, that's accurate. It's a SMID strategy. I'm the co-manager of. We also have a small cap strategy, which our founder runs. So I'm excited today because I think we have two talented investors to discuss the topic of investing outside the U.S. It is. Thank you for saying all that nice stuff, Ian. But the truth is, Cove Street, we're domestically focused investors. And so I really know next to nothing about how to navigate the markets outside the US. And so I'm actually really interested to hear from Jeff, who is a good friend of mine, and Ben, who I think I met when he was still in college at Occidental many years ago. And he's become a successful investor in his own right. So I'm excited to hear from them on how they navigate the markets outside the US and what their search process looks like. But what I want to do first, just so people can get a little context, Jeff, why don't we start with you? Just give me just a brief introduction to yourself and your firm, and a little tiny bit about the strategy, so people have a sense of how you think about the world.
Sure, thanks, Ben. Let's see. I run Startfort Capital, and basically it's a deep value international strategy focused on mostly, we call it monopolish industries. So it's mostly industry first. Where I think identified a number of industries that have really good base rate outcomes and successful business economics, and focus on those across geographies.
Great. Ben, why don't you go ahead? Same thing, a little bit about your firm and a little bit about yourself, and then what strategies that you work on. Okay,
great. Yeah, so I'm an analyst, and I also run our friendly activism practice. I work for a firm called Kabouter Management. We're based in Chicago, but we invest exclusively outside of the US. We manage about 5.3 billion across 4 different strategies, but we utilize the same team, and everyone works across all of those strategies. So we have a international micro, international small, international SMID, and emerging market small cap. And so we're looking for high quality companies that benefit from long-term structural growth. And we're trying to buy these companies at a discount to what we think their fair value is, using a global set of comps. And during our long ownership period, we engage with these companies to try to help them in a number of areas. We're not a traditional activist investor. We are a friendly activist investor. So we focus on topics that management teams usually find valuable, like investor relations, helping these companies get their materials into English, for example, ESG topics to help them improve their disclosure, and a number of others. So over a very long ownership period, we engage on these topics, and we try to add value both by picking great companies that will outperform, but also by helping them accelerate the discovery process as they become more institutionally investable.
Great. That's really helpful context. And so what we're going to do is we're going to dive into some questions. But in the meantime, if anybody in the audience wants to ask a question, please feel free to put to type it into the question and answer section. And then towards the end, we'll maybe save 10 to 15 minutes for Q&A. I could probably go a couple hours with these guys because it's such a fascinating topic. But we'll pause at the end for listener questions. So Jeff, and I'm probably just going to bounce the same questions off both of you because I want both of your perspectives. So Jeff, let's start with you. So when you start your search process, you talk about starting with industries, but how does the country fit into that? And do you start with a country and look for an industry? Or do you start with a company and then try to figure out if it's a company? You start with a company and then you figure out if it's a country you want to invest in. How does that play into your decision making in your search process?
Yeah, I go where I think the value is, not where I wish it was. So I generally won't start out with the top filter being geographic. Like certain strategies might. I think you should search for what you're interested in finding. And I guess what I'm really interested in finding is great businesses run by great people at great prices in geographies that I'm comfortable investing in. And, when you think about it, you can't really risk aggregate mediocre businesses to be better than average, or average people to be better than average, or expensive stocks to be any less expensive. But, a lot of the country risks that come from being a little bit nomadic can be diversified, and arguably should be diversified depending on your perspective. So, I don't necessarily believe that starting out only with one country is necessarily the correct filter at the top of the funnel, or necessarily the right approach to have permanently, because it may not always be the right time to invest in a specific geography.
And let me push you a little bit on that. So let's just say that, for example, we've heard Dan Rasmussen from Verdad talking about how interesting Japan is right now. He's also talked a lot about UK and how that's interesting. Does that attract you at all? If you hear someone say, or a market that you see like just broadly cheap, does that get you extra excited to look at good businesses within there? Or again, you're not, because you say you're going to where the value is, and what if a country just, for whatever reason is out of favor? How does that factor in?
Yeah, well, then I pay attention to that country. Like I said, I want great businesses run by great people at great prices in geographies I'm comfortable with. So, if someone told me, hey, there's an awful lot of that in country X, I might, train my eye a little bit more on country X over time, because that'd be what I was looking for. Generally speaking, though, I'm not normally starting my search process or identification process with sort of a top-down view. It's more of a bottoms-up view that I think it's attractive to own, really attractively priced industrial gas businesses or airports or stock exchanges, and you could expand that out to a list of businesses that have repeatable powers that sort of cross borders. And I would sort of, I think if all of those types of monopolies or businesses were cheap in one country, I might try to take note of that and say there was something going on there.
Got it. So Ben, let's throw it over to you. So talk a little bit about your search process, and does it start with a country? Does it start with companies? I know you look for high quality companies as well. How does that process work? And it's kind of the same question to you, is like, if you hear a country is really undervalued or underappreciated, do you gravitate there to look for good businesses?
Yeah, I think so. We're similar to Jeff in that we are bottom-up investors. So we trust our ability to identify great businesses with a sustainable moat more than our ability to pick the next great country. And we're also looking for companies that usually have geographic diversification in terms of revenues. And so in many cases, the country where they're listed does not really it doesn't really influence whether they will be successful longer term. But that being said, there are some, like I agree that Japan is a really interesting market, and so there are countries that seem to be more target rich than others. Like I think there are something like 4,000 public listed companies in Japan, and 2/3 of companies below 3 billion in market cap have 0 sell-side analysts covering them. And so that is hard to find in other developed markets outside of the US. So I would say it's a particularly interesting place to find misunderstood or undiscovered stocks. And so we plan a lot of trips there. I will say though, practically speaking, our research process is driven a lot by travel in a non-COVID world. And so we have our screening process and we rank our universe, et cetera. But each of the analysts will travel probably once a month and go to maybe 10 to 12 countries a year. And so when we do plan these trips, we're trying to meet with the most interesting companies within that one country. And so in a way, there are some countries that just get higher priority because there seem to be more interesting ideas within that country. I think also, like, I like using keyword searches. So you like often there might be an industry that has been successful in one country, but that has that might be newer or it might lag in other countries. Like a good example would be like self-storage is quite mature in the US. In Europe, not as much. And in Japan, they're like 10 years behind the US. And so there are some interesting keyword searches that we've done to find companies that are kind of later in the development cycle in some countries where we've seen those similar businesses be successful in other countries. And so we will do, I think, some of those like top-down screens, but for the most part, we're bottom-up investors.
Got it. And I'm always interested in this of like, do you have, and maybe to start with Jeff, do you have countries that fit in a hierarchy? Like these are the, you know, whatever, these are the 10, 15 countries that I'm comfortable investing in. And then on the other side, are there just like, I'm not going to invest there, corporate governance plus disclosure plus language issues. I'm interested to hear how, like, I understand you're looking for good businesses, but also, but the country can matter a fair amount given like just kind of differences across them. So how do you, is there any intrinsic favor or you know, kind of distaste for certain countries?
Yeah, of course. I mean, it'd be crazy if you didn't have some preferences there, I think, for all of the reasons you mentioned. But, you know, I mean, there's like almost 200 countries, and a shocking percentage of those have stock exchanges. And I think if you put those in a list, 1 through 100, let's say, you would probably think there might be 3 camps: the ones where you were super comfortable investing in, and you wouldn't, overthink it, and then the ones where you think, you're open-minded, and so you'd like to see opportunities, but you're going to have to price a number of risks, and maybe, be a little bit more cautious than you would in that first set of countries. And then a third set of countries that are, probably hands-off for a bunch of different reasons. And, you can use your imagination on what countries those would be and why. And I think, let's say there were 100 choices. I don't know, for different people, it might be 10 in Group A and 30 in Group B and 60 in Group C. And, some people might invert those. But I think, that's an exercise most people could do pretty quickly, especially if you're traveling, as much as someone like Ben or something, where you have sort of a growth mindset and seeing more and more of these countries over time and meeting more and more of these countries. And, it's not a fixed circle. I mean, it's possible that a geography could move between groups, as we would have all seen in even our lifetimes. I mean, I think of what Poland would have been like when we were born versus where it is now. So those countries are gonna move a lot for different reasons. And of course, your circle of competence can grow geographically if you put in the time and energy. But I think, everyone's got to make up their mind about how many countries and companies are in Group A, B, and C. But I think most companies or most countries rather at least need certain risks to be accommodated for in the price.
So let me just ask another follow-up there. What would it take in your mind for a country to graduate? Like what kind of things are you looking for to say, in addition to your own circle of competence, but in terms of the the external factors that would start pointing to you that this could be something that would be interesting to you over time?
Well, it's not all, GDP per capita correlated type of stuff, right? So, I mean, I'm no expert in Japan, but, Japan has put a lot of effort into, it seems to me, making shareholders more of a priority or more on parity with some of the other constituents that are involved in business. And, if that continues, then maybe, Japan will be that much more attractive potentially. It's not an area I'm an expert in, but that's just an example of a country generally that seems to be, moving in a specific direction with regards to, its corporate culture and how they think about outside shareholders.
Got it. So Ben, same question for you. Maybe talk a little bit about how you decide as a firm where you want to prioritize your time. Are there, areas where you monitor them, but there are just too many red flags, and what are those red flags that would say, this is not something that we could, really put a lot of money to work now?
Yeah, I mean, this is kind of a joke, but when I read that book, Red Notice, I had decided I had no interest in traveling to Russia and investing in Russian companies. So I think like rule of law, confidence that we're not going to be like persecuted if we try to engage with management teams. I mean, I think those are some basic requirements, but I think it's more driven by the inventory of interesting ideas. And what you often see is that when a frontier market becomes kind of an emerging market and they have they have few companies on the stock exchange, the industries that are the first to list are usually the really capital intensive businesses. So you have like a lot of banks, infrastructure, construction, mining companies. And so a lot of those frontier and emerging markets are just less interesting for us because we're looking for what we would think would be higher quality business models, and companies that are less cyclical than a lot of those companies that are the first to list. But also I think there are cases when you find a really interesting high quality business in a country that's perceived to be low quality, and that can be one of the best opportunities to find value. Or that's also the case within industries. Like we had a software company that was characterized really as an energy company, but its business was far more similar to software company, high recurring revenues. That was interesting because a lot of investors just mischaracterized this company. Or that can also be true. Like if a country has, if a country's stock market is really dominated by cyclical industries, if we're able to find the one or two companies that don't have those characteristics, it's possible that local investors are just benchmarking those companies to that stock market's valuation, and therefore they have a much lower target price. So I would say again, I mean, we're looking at countries that have the largest inventory of interesting ideas, and that is really driving it, rather than saying, there are these 5 characteristics that we're looking for, and once a country meets those characteristics, then all of a sudden it's investable. I will also say we're small cap investors, and so another consideration is that in developed markets, and in addition to being an American, I'm actually a German citizen, and so in my home country, in a small cap company that might be listed in Berlin has a strong advantage in a couple of ways. One is they're able to recruit quality talent. 2 is they're able to compete, and they're often supported by government to compete with larger companies. The reverse is true in a lot of frontier and emerging markets, because the larger companies have the ears of the local politicians. If the smaller companies become too threatening, then they can change a rule overnight and remove any competitive advantage they have, or force a sale that we've seen in a few cases. And so I think we have to be really careful also about investing in small caps in some of these markets where small caps are actually at a disadvantage versus being at an advantage in a lot of emerging or in a lot of developed markets.
Wow, that's a really interesting nuance. Thanks for sharing that. So one of the things that we focus on at Cove Street is management and access to management and developing a relationship with management. And Ben, we're going to get to you, and I want to hear how suggestivism plays out when you're doing it outside the U.S. But Jeff, maybe talk a little bit about how you found both the investor relations activities and willingness of management teams to talk to U.S. based investors, and then a little bit about how important meeting management or IR is within your process.
I have had pretty good experiences with being able to speak with, I think, relevant constituencies at companies in these different markets. I think with the not caveat, but I think you want to be really serious about your interest and let them know that you put in a lot of time and are very, would be a good shareholder and have done a lot of legwork to understand, what it is that they've accomplished. And I think with that as a backdrop, I've had really excellent experiences with investor relations. But I think generally, the quote unquote traditional investor relations that a lot of Western companies and large cap companies have in the United States or in the UK, that is maybe different in some of these markets. And then it's also probably correlated with size, so if you are looking at Samsung, you probably can't talk to the CEO, but, I'm sure they have a very active investor relations team with a lot of people that you can get on the phone tomorrow. So it's a different sort of thing in a lot of these companies, but I don't think it's worse. To the extent a company lacks traditional investor relations, if that's a big reason or a big part of the mispricing, that's something I think that's pretty simple to underwrite. I mean, frankly, it's not a traditional risk, and if I knew that was the reason something was deeply mispriced, I'd be pretty comfortable with that if I really felt good about the long-term trajectory of the business and being treated well as a minority shareholder and that type of thing. And then, the other thing I would say is that there's a lot of situations where, you can talk to the management team or maybe you can't, but there's an awful lot of historical data in many of these companies, let's call it 10, 20, 30 years of, their capital allocation track record, their operations track record, their value creation or their value destroyed, how they've treated minority shareholders, the letters that they've written or not written to stockholders. So, the idea that, your hour or couple hours with a manager is going to sort of outweigh a very, very multi-decade track record of that same person, I think it's a very relevant, important thing to do, but I am sort of someone who thinks you can tell a lot about, a baseball player from their batting average type of thing. And, you can say, what are you going to do against the team next week that you're facing and that type of thing. But really, I think if they're extremely talented or treat people very well or very not well, that to some degree is something, you can figure out to some degree just with history.
Great. That's really helpful. Ben, let me pass it to you. Talk a little bit about how you've engaged with management during your career, and then how has your suggestivism in general been received? My guess is you have some interesting stories where it was really well received because maybe people were used to it, and then maybe in other situations, having especially a foreign investor coming in, say, with suggestions can be kind of off-putting to certain management teams. So I'd love to hear the importance of management to you, and also like how your suggestivism has been achieved over time.
Yeah, so I think access to management has been relatively easy. I mean, I started at Kabouter when we managed just 200 million and now over 5 billion. And I don't see a big change in the access. And so I think what's great about international small cap is you can be a relatively small fund manager and you have far greater access to management than you would obviously looking at big stocks. But I think, so we're looking for companies where the perception doesn't meet reality and where reality is a lot better. And one of the reasons for that is the company has just done a poor job articulating their strategy or a transition that they've experienced. Like what we find all the time is companies don't even have IR officers. IR is handled by the CFO, in some cases the CEO, and the management are used to selling their products and services to customers, but they're not used to selling their equity story to investors. And customers are looking for often very different information. Investors obviously are interested in seeing some of that information, but you would never tell your customer that the relationship is very sticky and as a result you can raise prices consistently every year, or that switching costs are really high, or even like customers are not interested in knowing what the growth potential is in the industry. Like they're not that interested in knowing that the outsourcing rate in a particular field is only 10% and it could grow to 50%. And like they're not, and those are things that investors are hoping to learn. So we find a lot of easy initiatives in just helping companies with really simple things like overhauling their investor presentation. Instead of just using their sales presentation that they use with customers, to just add a few slides that articulate the investment thesis. And what we find is over time, through engaging with these companies, we're able to make better fundamental decisions ourselves. Because I'll often come to a management team and say, you know, these were the 5 things that we loved about your company and the reason that we invested, but you only talk about 2 of those things. And so it gives us an opportunity to talk about the others. And sometimes management teams come back and they say, you know, actually you're wrong on that point. We really don't have that advantage, or they elaborate on something else. So we end up learning a lot more through the process. And so we've built up this whole playbook of initiatives that we can work on with companies to help drive their re-rating. And so like when we first invest in a company, the conversation we have with management teams are often, you know, nice to talk to you again. We have good news and bad news. Good news is we love your company and we've built up a big position. Bad news is no one else realizes how great you are. So can you work with us over the next few years to try to change that and to drive a re-rating? And management teams are often willing to engage with us, especially because they often own equity themselves. But also it makes their job easier if their cost of capital comes down, if their PE ratio goes up. And so you would be surprised, but many of the management teams that we engage with are very happy and willing to work with us. We're not showing up and slamming our fist on the table and saying, you know, you have to sell all your real estate and lease it back. These are very friendly suggestions, and we work on really easy things at first, and over time we try to build up to more difficult things and prove ourselves over time. We also have a very long holding period, so over 5 or 6 years, we're able to nag management teams into accepting some of our recommendations. So over the last 10 years, I can only think of one company that just refused to take any of our suggestions. And so all of the other companies have responded to us and have taken up some of our suggestions.
That's really impressive. I mean, I think it must be a testament to your acumen as investors, but also your approach, right? Because it really, you know, you can come in with guns blazing, or you can come in as a partner, and it sounds like you guys do a good job there. So what, you know, Jeff, since you're a nomad, as you call yourself, and you've done stuff in the US, you've done Canada, you've done, you know, Korea, you've been all over. What do you think, for people who are interested in investing outside the US, what are the main differences that you've seen, you know, that are important for, you know, an investor who starts to say, hey, I want to invest outside? What are the main differences between the US and outside the US?
Well, I mean, you still are a part owner in a business, and you'll, you know, share in the relative prosperity that the business ultimately shares with its investors over time. So I think, you know, there's probably more in common than there is apart, because you know, if you find the right situation, you'll sort of participate in that value creation. I think I heard this a long time ago from like a really Hall of Fame investor, and it took me a little while to sort of grok it. But I think when you're in a lot of these markets, Ben Graham style investing has not been in favor recently, but I think that is even harder in a lot of these international markets. And I think you really want things that are not only mispriced today, but are going to be worth considerably more in 10 years. Because, you know, maybe someone like Ben can come in and sort of fix their cost of capital. But, you know, if that doesn't happen, you are sort of signing up for their return on equity. And I think there are more natural forces to fix those mispricings in the US and Canada than there would be in many of these other countries. Certainly, many of these countries have more family-controlled companies or things that are founder-controlled, and that can be a good thing. But I think you're generally even better off in some of these situations or in some of these geographies in the situations that will really grow value significantly over time, as opposed to something that is cheap today, but you know is not necessarily going to create that much new value. Of course, that means it's actually not cheap today. But another thing, which I think, depending on the geography, this may not matter so much, but obviously a lot of domestic investors are probably thinking more about inflation right now than they were, you know, 3 years ago or something. But in a lot of countries, inflation is a real thing. And for, you know, a generation of investors in developed markets, they haven't actually experienced the what inflation does to business economics. I mean, they've probably read some papers about it or, you know, heard the history of what that did to capital intensive industries. But I think, at least for me, you know, I sort of knew it, but until I, you know, was maybe involved in something where every year CapEx was larger than depreciation, accounts receivable grew, working capital consumed cash. You know, you can see it on a spreadsheet, but when you're involved in a situation like that and sort of can more intuit what that means for your equity value, I think it's a lesson that, you know, you hopefully don't have to learn by by being on that end of the economics. But it's something that in many countries it's just a fact of life. But frankly, you know, United States has been very, very lucky not to have to think about that for a long time.
That's really interesting, Jeff, and it sounds like you're going to be really well poised to you know, exploit the U.S. market when and if we ever see any inflation, because it sure hasn't been any in any of our careers. You know, Ben, same question for you about the differences and things that people should be thinking about if they're thinking about venturing outside of the, you know, either North America or US to make investments.
I think one is like quite simple, but just accounting differences, like between US GAAP and IFRS. Like if you're looking at the treatment of research and development, whether you capitalize or expense it. I mean, some of those things can have meaningful effects on like EV to EBITDA, for example. So if you're looking overseas and a stock looks really cheap, I mean, it might just be because they've been capitalizing a lot of their R&D if they're a software company or whatever. So I think accounting differences is one. Communication style, I think, is also really important. During a few of my first trips to Japan, I realized that yes doesn't mean that management teams agree with what you've said. It just means that they acknowledge that you just spoke those words. And so you can literally leave one of these meetings and have a totally different conclusion than what management intended. And so I think understanding communication styles and having a good interpreter, if you have an interpreter, but also just really simply understanding some of those communication differences, I think is critical. And then maybe last would be like filing or legal issues to be aware of. Like filing requirements are different in each country. And not only are the filing thresholds different, but the deadlines for submitting your paperwork are very different. Like Singapore, you have to turn around really quickly versus other countries. And so that can be quite challenging. I think also countries like Japan have, and this just changed at the start of 2020, but you can't own more than 1% of a Japanese company that operates in a restricted industry or in an industry that is sensitive to Japanese national interest, which is not always logical. Like parking structures are sensitive to Japanese interest, or technology companies. And so in order to own more than 1%, you have to submit special paperwork and seek approval. And so I think it can be quite complicated if you are hoping to own larger percentages of these foreign companies, because you have to be aware of a lot of these things. Maybe lastly would also be acting in concert. Like often we talk to other investors in that are active in the shares of our companies, and there are different acting in concert rules. So in some countries, if you talk to investors that in aggregate own more than 29%, you have to make a takeover bid of the company. And it's not quite as simple as just you speaking to those investors. It also includes the other investors that those investors spoke to. So it's like a second degree connection. And that requirement is different in each country. And so we have an in-house general counsel. We have law firms in every country where we invest. And especially when it comes to engagement, we are using them all the time. And so that can be quite complicated, especially if you want to own large chunks. And we own 10% of a lot of our companies. So if you want to own big positions, you have to be really careful about the differences in legal requirements.
Well, my head is spinning a little bit when I think about the complexity of that. And I will say that it makes me feel good as a US-based investor not to have to think about that. We have a couple more minutes left. I would love to just do a quick question before we go into Q&A. Maybe just really quickly on currency, how you guys think about hedging, not hedging. Jeff, why don't you start like, how have you thought about this, and has your thinking on currency evolved at all over time?
I mean, with something like, the euro or the pound or the yen or the won, I think that in the long term, if it's a country you think will increase its citizens' wealth and productivity over time, relative to something like the United States, they've all got bright futures. I think long-term currency fluctuations will be, wins and losses on every, given investment, but it will come out in the wash over the course of 20 years. Obviously, a lot of countries don't have currencies that will come out in the wash. And I think, I'm not saying they're predictable, but there are probably some signs of that. And I think, hedging costs don't come out in the wash. So if you're investing on a multi-decade horizon, you could probably trade a little bit of volatility for, some compensation every year for a long time. And that, might be a good trade for some people. It might be a bad trade for other people.
And how have you guys thought about currency hedging and risk over time?
Yeah, so we just have a really simple rule that we utilize just to dampen volatility. So if a currency is overvalued by more than 15%, we hedge a part of our exposure. More than 25%, then we hedge a larger percentage of our exposure. And so I don't think that we haven't added much value over time, but it has helped. I think fundamentally as an analyst, it's also, I think, important to take into consideration, especially for companies that operate globally, because in many cases, their revenues and their costs are not evenly matched. And so currency fluctuations can have a really big impact. Like we saw I mean, now the euro is like 5% undervalued relative to the dollar on an average of purchasing power parity that we've done. But I mean, it's been like in the double digits for the last many years. And when the dollar strengthened, a lot of our European companies that had most of their costs in euros and most of their revenues in dollars or kind of dollar-linked currencies, they really benefited from that effect. They were either able to keep prices fixed, or they were able to enhance margins, or they were able to become far more competitive with their global competitors by lowering prices and maintaining margins. So I think currency is really important. And maybe also in terms of attractiveness, like Japan right now, its equity markets are cheaper than the US, but also the currency is 25% cheaper on purchasing power parity to its fair value to the US dollar. So you kind of get a double discount. You get the PE discount, but you also get the currency discount. And so if that would reverse, then I think that's another, and we don't really take that into consideration when we're allocating, but it's something that we discuss with our clients. And as a US investor, you can obviously benefit as the currency gets back to purchasing power parity.
Got it. So just real quick question. We have one question from Maurice asking about Canadian companies. Jeff, have you been active in Canada? Has that been a fertile ground, hunting ground for you, or not necessarily?
Sure, I've had great experiences in Canada, and I love Canada. I think it's a great country, and it's a great equity market.
And Ben, what about you? I mean, are you guys more far-flung, or would you also spend some time looking in Canada?
Yeah, absolutely. And I think in some ways, Canada is a good example of a market that's known for a lot of like energy, mining, like heavy industries, but you can actually find really high quality companies that have more recurring revenues, or like one of the global leading pilot training company is based there, and we were invested in that for a number of years. And it was kind of misunderstood at the start because it was only one of two like aviation support services companies within the country. But yeah, there are great software companies there. It is an off-index bet for a lot of like ex-US international managers, because Canada's not in the like EFI or EFI small cap, but we've always had a decent weight to Canada and some really interesting companies there.
Jeff, do you feel like it's a market that's underappreciated? Like it's developed, it's got rule of law, but it's kind of like, you know, the US, it's overshadowed by the US, and you can get valuation discounts that you don't think you should be able to get given the quality of the companies. Is that a fair? Have you ever seen that?
Well, I don't know if I want to make an overarching statement, and if I did, it would sort of apply to right now or the last couple of years, as opposed to it's something in perpetuity. I mean, I think most geographies have the opportunity to be over or underpriced in general, and I do sort of agree with Ben that there is sort of a commodity whip that moves a lot of companies that really don't have anything to do with that, including the currency. So, all I can say is that I think there are a lot of great companies and management teams in Canada, and I don't try to overthink it from there.
All right, so I'm going to do just one quick question for you, put you both on the spot. Jeff, an industry or country that, or an industry within a country that you think is really interesting that people should be paying attention to?
Sorry, just
like any, I know you like airports, I know you like, those kind of businesses, but is there something, without naming a name, but like an industry or a country that you think people could be really, people should be paying attention to?
Yeah, I'm very simple. I like a lot of infrastructure. I like a lot of, some types of consumer product businesses. I like things with network effects or route density or switching costs or those types of things. So, let's call it airports, ports, roads, stock exchanges, vertical classified businesses, search, what else? Industrial distribution. I can think of some of the things I own, like, really good consumer products, certain types of payment infrastructure. I could just go down a list. I actually think certain types of dealerships are perennially misunderstood and pretty interesting. But it's sort of a long list of things that I think are worth a project to learn about in the course of an investing career.
All right, and we got to sign off. Ben, just 2 words, anything?
A lot of industries ripe for consolidation. So if economies of scale make sense, and then IT services benefiting from increased cloud adoption, which really lags in countries like Germany and much of Europe that's been slow to adopt some of the technology we have here. So instead of betting on the technology creators, investing in the systems integrators is I think a safe way to capture some of that growth.
Great. Guys, thanks so much for your time. I think this has been really helpful for people. Please feel free to find these guys on LinkedIn and reach out to them if you have any questions. Thanks for attending. Thanks again, guys.
And thank you, Ben.